This is Nightly Business Report with Bill Griffith and Sue Herrera.
Take that. China slaps possible tariffs on $50 billion worth of American goods just hours after the U.S. hit Chinese products. We have the fallout and what could come next. What trade war? Wall Street freaks out at the open, but then does a big about-face and marches higher by the close. But what about me? If you're feeling confused and maybe nervous about a possible trade war, we have some advice on how to protect your portfolio. All that and more tonight on Nightly Business Report for this Wednesday, April the 4th. And we bid you good evening, everybody, and welcome. I'm Bill Griffith. Sue has the evening off. It certainly was not a day for the faint of heart on Wall Street today. Stocks started sharply lower on the open this morning following China's announcement of new tariffs on U.S. goods. The Dow was down more than 500 points early on, fearing this to be a significant escalation that could spread. But then something happened. The market staged a major comeback, suggesting perhaps that investors may see the back and forth between the U.S. and China as nothing more than part of the negotiation process. Now, that is all, of course, speculation. But one thing is certain, it was a wild ride for stocks today. In the end, the Dow rose by 230 points to 24,264. The Nasdaq climbed by 100, and the S&P added 30. Now to those tariffs. China retaliated with proposed levies on $50 billion worth of U.S. goods a day after the White House imposed its own tariffs on Chinese goods. Kayla Tausche sorts it out for us.
A trade tit for tat unfolding over tariffs. China unveiling the revenge it would exact if the U.S. goes through with its latest set of tariffs. China's retaliation against soybeans, wheat, and manufacturing, targeting America's heartland and Trump country.
We will, in accordance with Chinese laws, take measures to fight back, maybe with the same intensity, the same scale.
The announcement in response to the U.S. publishing a detailed breakdown of 1,300 Chinese exports the U.S. would target with tariffs as a punishment for intellectual property theft. The list ranging from cash registers and copy machines to consumer goods like dishwashers and flat-screen TVs. While China is readying its response, market strategists say it's not a trade war just yet.
So what we worry about in terms of is this a meaningful trade war? Is it to the point that it's affecting business confidence in a meaningful way? And I don't think it's sufficient to do so.
Some White House officials have doubted China would actually retaliate. China hawk Peter Navarro says China can't afford to risk its relationship with the U.S.
We come in peace here. The thing everybody on Wall Street needs to understand is just relax. If you look at the negotiating posture of this country, all these countries that are running huge trade surpluses with us have no incentive to rock that boat.
Bilateral talks between the U.S. and China on trade are still happening behind the scenes. Commerce Secretary Wilbur Ross said the public escalation belies a possible resolution.
Even shooting wars end with negotiations, so it wouldn't be surprising at all if the net outcome of all this is some sort of a negotiation. Whether that happens by May or it happens at some other time, that's another whole question.
Top trade official Robert Lighthizer is convening a mid-May hearing on the tariffs, and Treasury is studying whether to put new investment restrictions in place, giving the two countries until June to work out their differences. For Nightly Business Report, I'm Kayla Tausche in Washington.
Now, China's reaction is telling in that it shows that they are not taking this trade rift lightly. Eunice Yoon got a glimpse into the government's thinking when she spoke to China's vice finance minister in Beijing.
I got a window into how the Chinese are thinking about the tariffs in my conversation with Vice Finance Minister Zhu Guangyao. Minister Zhu has oversight over a working group on economic affairs for President Xi Jinping, and his message for American businesses and investors is that China will not be bullied by the United States.
China never yield to the outside pressure, and we hope, based on mutual respect, we can constructively find way to solve the problem.
He said outside pressure only emboldens China to act. The second message from Minister Zhu is that China sees itself as the hurt party. For example, on intellectual property, he said that China is making progress on intellectual property rights, but that the Trump administration is only taking this confrontational approach.
China recent years so hard work to promote multilateral system. I think not any reason to blame China for any cause of global protectionism, and that's fact.
And finally, China sees its tariffs as an equal response to the U.S.'s. Beijing feels it's only responding, but that it's not the aggressor. The vice minister said that that's why China chose to include U.S. aircraft on the list, since the Trump administration put Chinese aircraft on their list. However, despite all the tough talk, China is leaving the door open. The vice finance minister told me that China would welcome any top U.S. official, including Steve Mnuchin or Bob Lighthizer, to come for further negotiations. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Now, we have been throwing this word tariff around a lot lately. What are they exactly, and how do they work? Eric Chemi has a refresher for us tonight.
Tariffs, that's the word of the day. So what are they really? It's just as simple as a tax on goods. You can think of it like a sales tax if you want, but these taxes get assessed at the point of customs when goods come into the country. By the time we see those items on the shelves at the store, it's already baked into the price you pay. Different goods have different tariff rates. Many goods have no tariff at all. Countries use tariffs for a variety of reasons. One purpose is simply to raise money. Before income taxes were commonplace in America, tariffs were the main way for the federal government to raise money. Another reason is to protect domestic industries from foreign competition. That can especially matter when a country wants to promote a growing industry to give it a chance to survive. Tariffs can also be used to punish foreign countries by raising the final price of their goods, which would discourage consumers from buying them. Many consumer items currently have tariffs imposed on them right now, including certain kinds of clothing, shoes, and accessories like leather handbags, typically around 10 to 15%. So that $200 handbag could wind up costing you $230. For Nightly Business Report, I'm Eric Chemi.
Clearly, China's tariffs would have a huge impact on two particular industries that export a lot of goods to China. That would be autos and airplanes. Philip Lowe explains now why China's plan could be especially painful for investors and workers in those businesses here in the U.S.
At BMW's plant in Spartanburg, South Carolina, almost 1 out of every 5 SUVs coming off the assembly line will be loaded onto a ship and sent to China, where it will be sold for 25% more than the same model here in the U.S. And that's before an additional tax China is proposing. That would push tariffs on some popular SUVs in China up to 50%. Fact is, auto exports from the U.S. to China have soared over the last decade and now total more than 250,000 vehicles every year. That demand is one reason Mercedes and BMW have expanded production at their plants in the southern U.S. If there's a trade war and sales slump, will automakers pull back on plans to hire more workers? It's the same question being asked at Boeing, where it's been expanding production of its popular 737 line, with many of them headed for China, which is expected to order more than $1 trillion in new planes over the next 20 years. Will orders slow down if some of those planes cost 25% more?
For now, Boeing says it's still assessing what tariffs, if any, China may impose. As for the automakers, they're taking the same approach, aware that the U.S. and China could still avoid a trade war. Phil LeBeau, Nightly Business Report, Chicago.
The tech industry would also be greatly affected by the Trump administration's list of products hit by new tariffs. And as you can imagine, Silicon Valley is not happy about that. Josh Lipton has their reaction tonight.
This is the first of many.
The list is out. The Trump administration formally announcing which products could get hit with these new levies. There are a lot, 1,300 product categories, including many high-tech products like industrial robots and semiconductor machinery. Consumer electronics are included too, like flat panel televisions and certain kinds of cars, both electric and gas-powered. Though notably, the list leaves out certain other consumer favorites like mobile phones. companies. The USTR says this action is, quote, commensurate with an economic analysis of the harm caused by China's unreasonable technology transfer policies to the U.S. economy. The tech industry's response, not happy. The ITIC, the industry's trade association, whose members include Apple, Amazon, and Microsoft, calls the tariffs counterproductive, saying they will raise costs for both tech companies and consumers.
Some would be felt by consumers immediately, again, through prices on products. Many of them would be felt through the cost structure of companies that are incorporating inputs and building things and employing people and finding that the costs that they face to do all of those things are going up.
The Chinese released their list of 106 U.S. products that will get new tariffs, and there were not many tech products on it. Still, American tech companies, everyone from Apple to HP, have many of their products assembled in China and rely on access to that market, so the threat remains. Calmer agrees with the administration that the Chinese don't play fair when it comes to American tech, but he thinks the smarter response would be coordinated action with allies to pressure Beijing, not tariffs. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Now, two of the tenets of the Trump administration have been increasing growth and reducing trade deficits at the same time. But do the two go hand in hand? Steve Leisman digs in.
The Trump administration's theory of the trade case, that trade deficits should be reduced and it will help U.S. growth, sparking criticism from economists. The criticism comes after China slapped retaliatory tariffs on 106 U.S. products in response to $50 billion in U.S. tariffs levied the day before on China. Commerce Secretary Wilbur Ross reiterated on CNBC the administration's view that trade deficits are a negative for the U.S. economy.
We have had a big problem with trade deficit for a long, long time. This is the president who's going to get us out of it. He's determined to go forward, and this response should not have really surprised anyone.
The trouble for the administration is this. As growth increases, trade deficits increase too. The more growth, the more the U.S. imports, from expensive French wines to German cars to Chinese electronics. As the chart shows, when the economy contracts, imports fall. When the economy booms, imports boom.
You have bigger trade deficits when the economy is strong because we're buying everything. We're buying everything we produce and everything everyone else produces.
When President Trump came into office, the deficit was running at around $510 billion at an annual rate. In January, it grew to $576 billion, or a 13% increase, in part because the U.S. economy grew more, so people brought more from abroad. It may be possible to grow the economy and lower imports, but that's a theory that, so far, defies decades of past history. For Nightly Business Report, I'm Steve Leisman.
Craig Dismuke joins us now to talk more about tariffs and the cost, what it might be to the U.S. and the consumer. He's chief economist at Vining Sparks. Craig, good to see you. Thanks for joining us tonight.
Good afternoon, Bill.
Clearly, we're only at the proposal stage, so maybe Wall Street's getting a little bit ahead of itself. But even if we were to see 25% tariffs imposed on both sides, you still feel that at that point it wouldn't have that much of an impact on the economy. Why?
Well, correct. So if you look at, if you have a 25% tariff on $50 billion of imported goods, your net cost is about $12.5 billion to U.S. consumers or businesses, and that'll be absorbed by one of those two. That's in context. It's about 1/10% of GDP, less than 1/10% of GDP. If you add it to the tariffs that were already put in place on steel and aluminum, you're still at less than 1/10 of GDP. Just for context, it's the equivalent of about a 12-cent increase in gasoline prices. So it's not going to completely damage the economy. There is a small price that you'll feel, right. But it's not going to undermine the economy.
So it's that proverbial soup can that Wilbur Ross has been holding up recently to talk about the aluminum imports tariffs that they've been imposing there. But you feel, though, we could see an impact, though, if there were extended trade wars, a second or a third imposition of tariffs, yes?
Yeah, absolutely. And I think that's what the risk is. And that's why you saw the markets open down like they did this morning. The markets are very jittery when it comes to this because they're not used to this style of negotiation, I think. But if you were to see an escalation, if you were to see exactly what we saw today with the tit-for-tat response, then I think that would become more of a, and especially if you got other countries involved, then it becomes more of a concern for us. But at this point, it's not a concern.
Where do you stand on this issue that Steve Leisman just tackled here? And as we grow the economy, is it wise to try and reduce trade deficits or not at the same time?
Well, so, a trade deficit is one thing. When you look at trade barriers, so a tariff is a trade barrier. It's something that prevents free trade. Those are negative for an economy. They're negative for the global economy, but they exist in many different forms. So you can have tariffs, you can have quotas, you can have the government subsidize a certain industry, which makes your industry more competitive than other countries. You can have currency manipulation. All of those things are negative. They weigh on global growth, they weigh on global innovation, and they weigh on the global quality of life. So I think in total, tariffs, any trade barriers are negative. Trying to manage a trade deficit is, I think, really dangerous because that simply reflects the strength of your economy versus another economy.
Very quickly, we should bear in mind that one of the president's goals is to try and bring more production back to the United States. That's one of the ideas he has in imposing these tariffs. Do you think that's going to happen?
Maybe in some sectors we'll see a few jobs return. Right now the job market or the labor market is very hot. I don't know that we need that. But remember, when China puts tariffs on U.S. goods in response, we're going to lose jobs in those industries. So I think it's, I don't know if it's a one-for-one calculation, but certainly we might gain a few jobs. We'll probably lose a few in the process.
Craig Dismuke with Vining Sparks. Thanks again for joining us tonight, Craig. Thanks.
Thank you.
Time to take a look at some of today's upgrades and downgrades. Goldman Sachs downgraded shares of Whirlpool today to sell from neutral. The firm saying that the North American appliance industry has become very fragmented and faces tough competition from abroad as foreign companies ramp up production in response to U.S. tariffs on washing machines. The price target there also cut to $135 from $164, and today Whirlpool closed at $151.60. It was actually up 37 cents. Deutsche Bank lowered its rating on Domino's Pizza to hold from buy. The Deutsche analyst says that the stock's run-up over the last few years makes the valuation a little high, and the company is also facing increasing competition. The price target unchanged at $235 a share. Domino's fell nearly 1% today to $231.45. And Cowen is upping Boston Beer Company to market perform from underperform, citing what it called surprisingly strong results from the maker of Sam Adams in its cider and flavored malt products. Price target raised to $195 from $150. Shares finished the day at $204.50. That was up 5%. Coming up now, if you're concerned about a possible trade war, we have one strategist offering up potential protection for your portfolio. Some mixed economic data out today. Payroll processor ADP says that private companies added 241,000 jobs last month. That was better than Wall Street's expectations. They were only looking for about 205,000. And the nation's service sector slowed a bit in March, with the Institute for Supply Management's non-manufacturing index coming in below estimates and below February's reading. Higher prices help results at Lennar, and that's where we begin tonight's Market Focus. The home builder grew profits and revenue as it sold more properties for higher prices. Orders also increased, and the company said it expects to sell more homes this year than initially had thought. Investors like the upbeat forecast, sent the shares up 10% to $62.82. CarMax reported weaker quarterly results and profits as the used car retailer experienced a drop in customer visits. Revenue and same-store sales also disappointed. Shares still rose, though, more than 4% to $62.73 per share. DowDuPont warned that its agriculture division could be negatively affected by the ongoing U.S. trade dispute with China. The chemicals giant said that the proposed tariffs by China on imports of U.S. soybeans could weaken market prices and hurt U.S. farmers. Shares of Dow DuPont rose fractionally, though, to 63.69. And Facebook now says as many as 87 million people had their information improperly shared by research firm Cambridge Analytica. That's up from the previous estimate of about 50 million users. And Facebook also admitted that most of its users could have had their profile data accessed. The company currently has more than 2 billion monthly active users. Facebook shares were off a fraction today at 155.10. Now, if all this talk about a possible trade war between the U.S. and China has you nervous and worried, our next guest has some moves that could provide some protection to your portfolio. Joining us tonight, Paul Schatz is president and market strategist at Heritage Capital. Paul, always good to see you. Thanks for joining us tonight.
You too, Bill.
What do you make, first of all, of these knee-jerk reactions that Wall Street seems to have every time there's talk of tariffs between the U.S. and China?
I think it really fits in with the market's performance over the first quarter and the beginning of the second quarter. Look, volatility has been a huge theme all year. It's my #1 theme for 2018. This just kind of fits in with it. The market, volatility is going up. It's been suppressed for so long. The volatility genie is out of the bottle. She's not going back in the bottle anytime soon. We're returning to old volatility or the old normal. So regardless of what the news is, I think volatility is here to stay. Perhaps not as great as we saw today, right, but clearly volatility is going to continue to be heightened for a while.
Now, we keep talking about industries that could be affected by a trade war of some kind: agriculture, autos, transportation sectors, agriculture. Are those sectors that you see opportunities in, or would you avoid them until things sort themselves out?
So first, I think you have to have some kind of baseline view of what you think the tariffs will end up. So my personal view is, I think if we get anything, it's going to be a watered-down version, a negotiated version of what we're hearing from both China and the U.S. right now. Certain areas, I would let the smoke clear. Any sector that's had somewhat of a meteoric rise into January and is now declining off that, that's one area. Those are areas that I would avoid. Right. You mentioned agriculture. I think for the long-term investor, real agriculture, wheat, corn, soybeans, they haven't had their heyday in so long. I think that presents an opportunity. So I think it really depends. You have to boil down the sector, figure out where it is price-wise, figure out where the value lies. But the ones that have melted up, I'm probably not interested in right now.
Okay. Now, quickly then, what about those areas of the market that you feel could be protected or wouldn't be affected as much by tariffs? I keep hearing about domestic, small and medium-sized companies. Do you agree with that?
I do, and if you look, since the market peaked in January, small caps have done fairly well. They lagged for several months, and they kind of got up off the mat. They have led. It's been led by small cap growth. Remember, small cap companies do most of their business in the United States. So in theory, you think they're more protected. Now, if the trade war is as bad or worse than it's painted right now, that declining ship, the sinking ship, everything's going to go down. But regardless, small cap value, which hasn't had its day in the sun yet, is one area that the individual investor should at least look at, because there should be opportunities going ahead for a sector that has not led yet.
All right. Paul Schatz with Heritage Capital. Always good to see you. Thanks again for joining us tonight, Paul.
You too, Bill. Thank you.
All right. Coming up, Hamlet once told Ophelia, "Get thee to a nunnery." Well, she might want to head to one particular former nunnery that is now a $50 million mansion. We'll take you inside coming up. Finally tonight, a former convent in the famed Hamptons east of New York City recently sold for a whopping $50 million. Now, it's been widely reported that the location was owned and remodeled by the late fashion icon Vince Camuto. Our Robert Frank was given a rare tour inside this sprawling estate.
Behind these wrought iron gates sits one of the most exclusive properties in the Hamptons, called Villa Maria. Believe it or not, this sprawling waterfront estate used to be a convent for Catholic nuns. Now it's on the market for $72 million, and we're getting a rare glimpse of some of the mansion's signature features.
This is the first time cameras have ever been allowed in this house, and it's probably going to be the last. Let me take you through. The owners purchased the property in 2005 for $35 million. They invested an additional $40 million over the course of 6 years, making it what you see today.
Broker Cody Wyszynski can't reveal his client's name, but it's widely reported the summer residence belongs to the family of the late shoe designer and co-founder of Nine West, Vince Camuto.
If you look up, you'll see a dome imported from Italy that is centuries old. This wrought iron balustrade is custom made in Austria by a gentleman whose sole job is to make this look like it's been here for 100 years. This beautiful adorning column has been here for 100 years. Let me take you to the master suite. It's 2,700 square feet, made up of 6 rooms, and spans the entire western wing of the house. Killer office. You'll notice that all the furniture was custom made for the house. It's meant to evoke Hampton chic. This marble tub was cut from a single piece. It weighs about 4,000 pounds and was craned in.
A few weeks after Cody took us on this exclusive tour, the property changed hands for just under $50 million. And we'll bet the buyer is thrilled that Villa Maria was restored to the nines.
For Nightly Business Report, I'm Robert Frank.
Oh boy. One last look at the day on Wall Street today. Very volatile day from bottom to top. A 700-point swing for the Dow, which in the end was up 230 points. Was down more than 500 at one time today. The NASDAQ climbed by 100. The S&P added 30. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching. See you tomorrow.